When markets stop sleeping, how Wall Street is building 24-hour financial control. For most of modern financial history, markets followed a ritual rhythm. They opened, they traded, they closed. The bell was not merely a signal, it was a boundary. Time itself acted as a form of regulation, forcing pauses, synchronization, and collective restraint. The era is ending. The move by Nasdaq to pursue a 24-hour weekday trading is not a marginal adjustment to trading hours. It's a structural redefinition of how financial power is exercised, how capital flows are controlled, and how global markets are subordinated to infrastructure rather than geography. This shift is not about convenience, it's about dominance. The death of the bell. The closing bell once symbolized order. It compressed global activity into predictable window, forced the world to react in batches. Asia waited for New York. Europe positioned ahead of it. Information traveled, but execution was delayed. That delay mattered. It created breathing room. It allowed interpretation before reaction. A market that never closes eliminates that space. When trading becomes continuous, reaction replaces reflection. Capital moves instantly. Narrative control migrates to whoever owns the pipes through which orders, pieces, and settlement flow. In that environment, the bell is not obsolete because technology made it so. It is obsolete because power no longer benefits from pauses. Time zones were always a weakness. For decades, US markets enjoyed dominance despite a glaring flaw. They were offline while half the world was awake. Asian investors digested American news after the fact. European institutions adjusted positions in anticipation rather than participation. The asymmetry increasingly conflicts with a world where news is instantaneous, capital is mobile, digital assets trade continuously. When information moves 24 into 7, but execution does not, markets lose relevance. The response is not to slow information, but to eliminate downtime. Near continuous trades convert US exchanges into global reaction engines. Wars, elections, earnings, sanctions, crisis, everything can be priced immediately on American infrastructure under American regulation oversight. This is not a market upgrade. This is a time zone conquest without borders. Retail didn't lead, retail forced adaptation. Contrary to popular narratives, this transformation didn't originate with institutions. It was forced upward by retail behavior. Platforms often extended or quasi-continuous access normalized trading platforms and traditional sessions. Once a critical mass of volume migrates to offline hours, exchanges face a dilemma: either absorb that behavior to watch relevance erode. Institutions do not innovate for novelty, they formalize what has already been proven unavoidable. By the time Nasdaq filed for extended hours, the behavioral shift had already occurred. The filing is not leadership, it is capitulation to structural reality. Why exchanges alone cannot do this? An exchange doesn't operate in isolation. Trading hours are meaningless unless the entire market stacks stay awake. For nearly 24 hours to function, the market must align clearing and settlements, consolidation data feeds, risk management systems, broker-dealer systems, custody and margin infrastructure. This is why the role of depository trust and cleaning corporation is decisive. Clearing is a circulatory system of finance. Without it, trades are illusions. Plan to move clearing towards 24 into 5 operation represent a far deeper shift than exchange feelings. They signal that financial nervous system itself is being rewired for continuous operation. One clearing settlement and data never slip. The argument for limited trading hours collapses permanently. Liquidity is not continuous. That's the risk. Markets can be open without being liquid. Distinction is deliberate, occurred in promotional rhetoric. Liquidity cluster, it concentrates on market open, market closes, major data releases. Overnight, sessions are structurally thinned, fewer participants to wider spreads, higher sensitivity to marginal orders. This creates a paradox. Markets become more accessible, price may become less stable. In low liquidity environments, information shock do not diffuse, they detonate. Price discovery becomes sharper, faster, and more violent. This is not a bug, this is a feature of a continuous market. Volatility migrates from scheduled windows to unpredictable hours. Real participants interpret accessibility as opportunity. Institutions interpret asymmetric terrain. Institutions will not behave symmetrically. A critical misconception is that extended hours democratize markets. They do not. Institutions will. Overuse overnight sessions selectively, exploit thin books, avoid unnecessary exposure. Retail participants, by contrast, are more likely to trade continuously, reacting to headlines, price movements, and social amplifications. The result is not equality, it is strategic participation. Markets do not become fairer when they are always open. They become more efficient to those who understand when not to trade. Infrastructure is the new sovereignty. Historically, financial power followed flags, armies, treaties. In the modern system, it allows infrastructure ownership. That exchange holds the most liquid instruments, clears the most volume, publishes the references prices, never goes offline, becomes the default venue for capital global. This is why competition among exchanges like New York Stock Exchange, CBOE, global markets, and others is not about hours per se. It's about being the last system standing when others are focused to follow. The psychological shift, markets as environments, not events. Traditional markets were even for prepare you prepare for the open, you position the close. Continuous markets are environments. They surround participants at all times with no reset, no clean slate, no collective pause. This changes behavior. Fatigue replaces anticipation, reaction replaces planning, and presence replaces timing. The most revealing aspect of the transformation is how little drama surrounds it. There is no revolution, no manifesto, no announcement of conquest, just long hours, then continuous clearing. Power no longer declares itself, it installs itself. Markets once closed to protect order, they now remain open to protect power, and power doesn't ring a bell when it takes over.